But if Ethereum doesn't have liquidity, you can't process your transactions, you can't validate the network. So that means that being a market maker in this space, you can do market making as a service, and it becomes increasingly important as you're taking your disruptive technology to the market and trying to scale it. And that's why people like us and other people have been able to build very big client franchises as market makers.
Hey, everybody. It's Eri from Tokyo. This is your cryptocurrency update from Japan. And there's a lot of conversation going around about the new automated market maker that's coming to the XRP ledger. In the crypto world, what does a current market maker do? What is the role? What are the bottlenecks? Why do blockchains even use market makers? This panel that you see before you are makers that are standing ready to buy and sell for OTC desk, exchanges, and institutional investors, improving that order execution, the liquidity, making it very easy and more efficient to buy and sell. Today's market makers use software engineering and algorithmic tools with rigorous human oversight in a high-frequency trading environment. Here is Aya Kantorovich. She's the head of institutional coverage at Falcon X. It's interesting to learn that it's very much still a fragmented sector. You have the OTC desk, which are the dark pools. You have the lit pools, which are exchanges like Coinbase, Kraken, Bitso, Bitstamp. But this is not a market that is really liquid yet in comparison to the traditional markets, but it is getting there. Have a listen.
Roughly 4 or 5 years ago, a lot of crypto liquidity was retail driven, and so you started by having local exchanges around the world that popped up as the central hub for retail to get access to crypto. So you would see Bitso in Mexico, Bitstamp here in Europe, Coinbase, Kraken in the US. And then primarily as institutions started to get interest in crypto, you had this demand for OTC desks, over-the-counter desks, or market makers, as you see the folks on the stage today. And what you started to see was this fragmentation between those that wanted very large order sizes, so anything over, let's say, 1 or 2 Bitcoin, and those that wanted smaller order sizes, so more retail-facing platforms relative to institutional-facing platforms. So you have a number of different liquidity providers today. It'll be anywhere between lit pools like exchanges and then dark pools like the OTC desk, as well as a lot of venture funds, miners, all of these folks who have really large balance sheets, protocols, treasuries that want to exchange their crypto, but don't want to do it on an order book today because it'll have an impact on price. But we're still not as liquid as traditional markets, and it's still fragmented, but we're definitely getting there.
Here is Markus Infanger of Ripple pointing out crypto is too big to ignore and it's not going away, and liquidity growth will be part of the landscape.
Before it was predominantly retail driven, and now things like Bitcoin achieving 10% of the market cap of the whole gold market, or a company like Coinbase with 1,500 people generating revenue commission income the size of traditional investment bank with 40, 50,000 people. It's just really open up the eyes. So it's fair to say, in the eyes of traditional large institutional players, this place has become too big to ignore. No, it's not a fad. It's not going to go away anymore. And so all of them are looking for an entry now. And also regulators, which are obviously key stakeholders for the whole adoption to thrive. They can no longer ignore it. So as these two dynamics now are playing out, that will just underpin so much more liquidity growth from here as I see it.
And now Ed Carlton of Flow Traders speaking to the role of market makers. Price discovery is key.
And the role of the market maker, contrary to popular belief, is not just about making money in a profitable business, but it's about price discovery, creating a clear and transparent and fair market. And this is definitely something that resonates with flow traders, and that we try and emulate from what we know in traditional markets over into the crypto markets.
The 24/7 world of crypto.
And 24/7 support is really expensive. You need to have people working weekends. You need to have people who are constantly checking books. When you think about even in traditional financial markets, when they make you take 2 weeks of vacation so they can check through your books. You don't have that in crypto. And you don't have weekends and holidays as well too. So all of that leads to the expense, but you have to do it for the type of institutions entering.
Back to Markus of Ripple. He gives an example of how they source XRP to solve real-world problems and, listen to this carefully, can scale into the trillions.
I think everybody would agree most of the crypto liquidity right now serves sort of the use case of speculation, fueled by incentives and so forth. And not denouncing that, I think it empowers the industry to really innovate. However, I think as as crypto matures and lives up to its full potential, I think this notion of real world utility will become increasingly more relevant. And just to give you an example, so we at Ripple, with our flagship product, on-demand liquidity, we're literally harnessing billions of dollars of XRP liquidity to facilitate cross-border payments in a couple of seconds from, say, the US to Mexico instead of your 2-3 days like in legacy systems. So really solving a massive pain point in this world, which is how money moves around the world. And these are use cases that can scale in the trillions. So I think the future of crypto liquidity will be shifting more towards solving real world problems as opposed to just speculation.
Here's Bybit. See how important crypto liquidity even is from scattered locations around the world in places that don't have access to US dollars.
For people who are living in double-digit employment rate combined with double-digit inflation rate, and many of them don't actually have access to bond market, don't have access to US stock market. Many of them don't even have access to US dollar. So crypto is serving a real need there, where it's the only liquid asset that you can trade globally.
Back to Ripple's Markus. DEXs, the decentralized exchanges, will even be powered by enterprise use cases.
Institutions will start to allocate, they start a little bit into this whole DeFi economy. And over time, I see literally DEXs, like for example, the XRP ledger, that's actually the oldest DEX on a public blockchain. I see a decentralized exchange like this really powering enterprise use cases, even like on-demand liquidity, where we use regulated exchanges right now to facilitate cross-border payments.
This next clip is so interesting. The cost, if you are a blockchain company, to get on an exchange is going to cost you around $200,000, and you need to partner with a market maker. And there is a cost associated with that. Those blockchains that don't have the capital usually first then go to a DEX.
Today, if you want to go to market on exchanges, it costs $200,000. For listing, and then you have to partner with a market maker, which has a cost to it associated as well. Now, you will get a more institutionalized product and process out of that, and you will target a much more institutionalized base. But for a lot of protocols who don't have that kind of capital and haven't raised that kind of round initially, but want to go to market, they can launch on these DEXs directly with liquidity on both sides, and then garner interest through Twitter or other community measures. And so you've seen actually a lot of that work for certain providers, and then for other providers, you've seen that completely fail, which is just the power of having a market maker to start. And relative to that, if you are looking for overall growth, your protocol will only gain X amount of traction until it just needs that institutional capital and exposure in order to grow much larger. So what you've seen is a lot of that initial price discovery will start potentially on DEXs, but it will inherently move to Coinbase or in the US or other exchanges, Binance, Huobi, OKX, etc., internationally as well too. And
now we get some deep insight. The relationship the market maker and the token have. Yes, liquidity is one component, but secondly, positive cash flow is the goal. And they do that by providing a price range that is pre-discussed. And then finally, they need inventory. The market makers are loaned tokens so that they can make that market.
The market maker it should be aligned with the token issuer in the sense that what needs to happen for the market maker in order for them to be compensated is that the market, first and foremost, needs to have liquidity. So that's what they're hired for. Two is that they will provide a positive cash flow to the token project themselves at prices which the token project, to a degree, can choose, which is above the current price. So you create a very aligned model that seems to be working, and you certainly don't want to create negative cash flow. You want to create positive cash flow. And the other part is when we talk about it's impossible to market make a completely new token without having that token. I need the inventory, otherwise there is no markets to be made. And the loan is important because you talk about what is the scale of the market making that you provide. What you want from your market makers, they should provide a significant amount of liquidity. And as a market maker, you assume that risk. So if you're putting $5 million on the bids and $5 million on the offer, your job is to manage that inventory across multiple exchanges, centralized and decentralized. And if you screw it up, the loss is on you, not the project. But so the loan in that case is very important. And I think that's very much a sort of a discussion. I don't say every single deal is the same, and it shouldn't be, because the token economics is different, the outlook, the roadmaps. And as a partner, if you're a market maker, you need to adapt to that as well. These markets are not very liquid. Crypto is not liquid. It's very active, but it's not very liquid. Something that is very liquid doesn't move around at 100% vol. So I think that we need to be careful about what we think is liquidity and what we confuse liquidity with activity.
Back to the head of communications for Bybit. The demand for crypto is there, but the bottlenecks come from the on and off ramps with the banks.
Like, there's always so much demand. Even anecdotally, we know actually the biggest bottleneck comes from the traditional banking industry. It's on-ramp, off-ramps are just so notoriously hard, and because essentially it's not an inherent problem of crypto itself. There's always more demand.
To finish it off, this is Markus, and he lays out the future.
And I think, it's pretty exciting to think about all the possibilities by connecting different value networks, and at the end, ending up in a situation where, everything is tokenized, you can trade any asset against any asset, and there's going to be liquidity.